Hello and welcome to the India Investor Week special on the Money Show, your one-stop destination for all your personal finance queries and strategies. I'm Kavita Thapliyal and today's special edition is dedicated on risk management. Speculation is on a high, but is it really all that bad to put your money in risky assets? How do we assess your appetite to do F&O, crypto, NFT, etc. and on what basis one can take these risks? It is your hard-earned money after all that we are talking about. So how do you analyze how much to put in these safe assets and how much risk can be taken and with what kind of investment? So let's deep dive into all of this and we will get your risk in investments analyzed today. And on the panel I have with me Ajit Khurana, crypto expert, and Feroz Aziz, Deputy CEO, Anand Rathi Wealth. Good evening, and Ajit, welcome to the show. Ajit, let's first begin with your understanding of taking risk in investment. You know, you've been associated and a crypto investor for a very long time now. You definitely have a very high risk appetite, but apart from that, how do you understand your risk profile and the risk profile attached with the investment instruments or asset classes that we are going to talk about today?
So, first of all, I don't think that risk and chance mean the same thing. Chance is random, it's a gamble, it's a lottery, while risk is more something I can model, I can understand, and make a decision based on that. So I do think I'm a very highly risk-seeking person, despite being 55 years old, but I only take risks in assets that I have spent many years studying and being in the market with.
All right. So I also have Feroz with me connected now. Feroz, if you can hear me, we were just discussing about the kind of risk that's involved in the investment and the kind of risk profile one has of their own. So Ajit just answered that for himself. If you're connected, if you can hear me, Feroz, what's going to be your risk profiling and what kind of a risk appetite do you have, Feroz?
Kavita, see, I think, like you rightly said, risk, and Ajit Saab also said, risk and chance are different. I think that's a very, very valid point. I personally think risks are of different kind. I personally respect or only worry about those risks which are permanent write-off to capital or permanent reduction in capital. Now, what are these kind of risks? Now, if I look at credit risk, it can mean permanent write-off of capital. For example, if I've loaned my money to some company and the company goes bankrupt and does not have enough assets to liquidate and pay back all the people who deserve to be paid back, that's money gone for good. That's permanent risk to capital. Those are very, very sensitive risks for me as a person. Second, I personally think any risk which is price risk, which is of an asset which has an intrinsic value temporarily on a piece of paper which is called portfolio, if it shows lower, it doesn't bother me as much because the risk disappears and corrects itself like a wound. The risk can either be like cancer, which magnifies with time. It could also be like a wound, which heals with time. So market risk or price risk, especially in equity, because there are so many people going to work. Now, if I buy a large company, there will be lakhs of people going to work and creating value day in and out. And that will, over a period of time, make sure that the businesses do well in most cases, not all cases. So that's why I think risk has to be categorized as permanent loss to capital or temporary loss to capital or return. The temporary ones are very intimidating, but they don't need to be so as intimidating as it is for most common people.
Right. But Feroz, can we do without taking risk? Is that right that, we just do not take any risk in our portfolio and still expect good amount of return or earning on the kind of investments we've got done across asset classes?
Kavita, you're so right. See, there is no gain without a pain, right? You want long-term great inflation beating wealth creation, right? And you don't even want to have a little disturbed sleep once in a year. See, so basically, you can't expect the moon from the world. And then I think there is something wrong with the human expectation that I should reserve 3 times more than an FD. And it should not even fall 10% in the interim, momentarily. Now, that's an unfair expectation. If that's the expectation you have with money, I dread to imagine what's your expectation from your spouse. right? So point I'm trying to make is you have to have fair expectations, be it an asset or a human being whom you're expecting something from. So that's point one. Point two, I think what can you expect? I think if you're speaking of equity, which is supposed to be risky, which it is in the short term, it falls 10% every 8 months on an average for the last 24 years. Every 8 months, you will see a 10% correction from peak to trough. So if you are not used to this, then you don't deserve 3 times more than a FD post-tax.
All right, so Ajit, I really want you to share with our viewers the kind of crypto experience you've had so far. You've been an investor for a very long time. And what kind of a separate risk appetite, or do we really need to have a different risk appetite to invest in cryptos or other risky asset classes? You know, if you can also talk about FNOs. How has your journey been in terms of taking that kind of a risk, and how would you understand risk related to these kind of asset classes then?
I first started studying Bitcoin, specifically not crypto in general, in 2014. And it seemed quite bizarre and frankly illogical to me at that time. Having said that, there was something new, a kind of new promise that it brought about. So I spent 2 years studying it, actually doing a course from a US university on it, before I put in my first 1,000 rupees. So 2014 I started, 2016 I started investing. And then I kept in touch with the market. I kept talking to founders. I kept talking to engineers. And I personally feel that when it comes to taking risk in these asset classes, if you don't understand them, for example, I may not understand how oil prices or certain commodity prices move. You can still take a position in them, but a very small portfolio, like a very small position, which is part of a very large, well-diversified portfolio. The moment you want to start even going beyond 1% of your net asset into a specific asset class, which is especially high risk, such as cryptocurrency, I would say your understanding of this space should be much more. I would not recommend anybody invest large amounts in crypto if A, they don't want to lose the principal, or B, they are going to take only very small positions in this.
So, Feroz, talking about young India, that if we talk about what past, as if you have to compare since what 3 to 4 years back now, what kind of risk understanding do they have? Because we know that young India or young investors are flowing towards risky assets. You talk about FNOs, you talk about crypto and other asset classes. At the same time, they are slightly passive or not so exciting attitude towards mutual funds. Share markets, yes, obviously we've seen the equity participation numbers. Even the SIP numbers, in fact, have been reaching a new high every month. But what's the change in terms of risk mindset, if I have to ask this, especially connected with young India or young investing India?
Yes, Kavita. I firstly concur again with what Ajit Saab said, that it is not about, it's about how much amount you're going to invest. If you're going to invest a substantive portion of your wealth, you better understand it, deep dive, and then figure out each element of the asset or a specific commodity you're bringing into your portfolio. And risk doesn't come with what you do. Risk is actually defined by how much you do of what you do. Right? If I put one third of my money in a specific asset or a specific share or a specific business as a startup promoter, then that's substantive portion. So coming back to your pointed question of what do you see as a trend, I think the good part of the trend which we identified is that people who are gambling or speculating, what do I mean by speculating, is not understanding the asset or the instrument. Now, for example, if a person is dabbling in derivatives, which is something which I have understood a lot more than crypto, pardon my ignorance, my knowledge on crypto is significantly lower. But on derivatives, what is clearly coming out is that speculators largely don't understand even option Greeks. What is delta, gamma, vega, theta, rho, vera, and veta? If you don't know these seven, people have not heard these, and they're dabbling in derivatives. So it is speculation if you don't know these elements. But most people who are speculating with not more than 2, 3, 4% of their wealth, which is quite an easy feeling for me when I speak to them. They're doing 30, 40, 50% of their savings into something which is more tangible, more stable, be it real estate, gold, or equity mutual funds in the form of SIPs, and only about 5, 7% is what the same person is dabbling with. And I hope that proportions don't change in the long term, and that adrenal is good if it is 4-5% of one's net worth.
So Ajit, will it be right to say that instead of going for a risk mitigation strategy, one should be looking at risk diversification strategy in their investments?
So very interestingly, Warren Buffett was asked what is the appropriate portfolio size. While he continues to tell people to invest in passive index funds in the stock market, he himself said that if you could get three good in my case, I think that you should risk diversify in two ways. Find assets that you like and understand, the characteristics of which you are very happy with, the level of risk and the expected level of return are the kind that you like, and make sure that 2/3 or more of your portfolio are in this basket of assets. For me, that would be cryptocurrency because that is my single largest asset, and probably some amount of debt-based, bond-based investment to provide a little bit of security, which probably is about 10% of my asset. If you are a professional in another field, which means investment is not your full-time business, and there is probably no asset class that you can claim a certain level of expertise in, then diversified portfolio is probably diversified and at least significantly passive portfolio is what you're looking for, because you will never find the time as a doctor or maybe as somebody who's a chartered or an engineer working on an oil field to really spend the time and effort on figuring out investments.
All right. I think we've discussed a lot on risk related to your investments. My time is up for this discussion, but thank you so much, Feroz and Ajit, for taking time out for this particular hand-holding, that you did for our investors, and especially our young investors. Thank you so much. All right.